Good afternoon, everybody. My name is, of course, Brian Downing. I'm going to be showing you the importance of using government data, or I call it government data, that will forecast where the market's going to go. So I'm going to show you the rationale behind it and the relationship between forecasting the S&P 500 performance versus using forward-looking PMI from the ISM, which is part of the U.S. Manufacturing Index, or Manufacturing Purchase Managers Index. That's what it stands for. So as you can see, this is going back all the way back at least 20 years. You can see here, this is S&P 500 performance, and then you also have the ISM PMI, okay, in the blue. You can see it's very close, and I don't know why people don't use this as a metric to forecast where the markets are going when you're holding long-term positions. Now, if you don't believe these sort of this type of relationship, which is being shown right in front of you, I would strongly advise you to get out of trading while you can, because you're going to lose money otherwise. This is like a very simplistic, very classic relationship that can be used to help you earn money. It's like literally having a little print press that prints money for you. And if you can automate it and scale it and do other things, you can maximize the opportunities that it brings. So this is just the PMI and the S&P 500 earnings. Okay. Now this one is forward earnings and the ISM PMI again. Now this is the actual in blue of the S&P performance. But when you look at the S&P forward earnings, what does that mean? Well, guess what? You got another indicator that I use is earnings price per share from your leading longs that you believe that are going to be long. And I've got indicators and all that are working, scripts that actually do that track the EPS of companies. Part of my system now I'm building called the AK-47, I call it for internal uses only, does all that. And it also is now going to be charting all this. I'll be showing that in a new upcoming video. But I just want to show you the relationship here. It's that simple. And it works. And it's been working since 1990. In 2014, going into 2015, which obviously lasts 25 years. And it goes, you go all the way farther back and see that relationship. It might not be exact, but it's pretty damn close. And here's another one. I'll put both these links in my blog so you get to know it. And these are the different types of relationships that you can see. Again, S&P revenues per share, EPS, with the blue line, 52-week forward on the EPS, on the revenue. And then you can see the PMIs that can be also used as well. World Industrial Production. So you can easily, since 95, see the relationship. That's how, of course, over the last 20 years. Now, here's the S&P 500 revenue, world exports. Important relationships. So like I said, I'll be putting up a video. I've got 3 programs that'll be showcasing this type of stuff. It's not going to be showing the U.S. economic indicators or all that, and then you can. I should also mention GDP has the same relationship with PMI, okay? Because the U.S. represents what, 50% of the world's between Europe and China and U.S. that's 50% of the world's GDP, and of course U.S. is one of the biggest global powerhouses on an economic front. So there is a solid relationship here, okay? You cannot deny that. You can also use it for forward looking, and then you can also use to drill down how to maximize those opportunities and this classic relationship. Again, here's world crude oil demand. So there is relationships on these indicators with the stock market and how the markets perform. Okay, so we're using these kind of metrics to gauge forward-looking market direction on S&P 500. Okay, so I'm just going to leave it there, let you go through all of this, but these are really simple, classic relationships that I need to show you. So again, this other video current will be another part of another video. Watch it. and see one of the big benefits of what I'm building here. All right? Talk to you later.